Think about the silver in your hand. It feels heavy, solid, and real. But what if the entire market is built on a lie? For decades, silver has been called the poor man's gold. Lately, something about the price doesn't add up. You see the demand skyrocketing in electronics and solar panels, yet the price stays oddly suppressed. Have you ever wondered who actually benefits from keeping silver cheap? The numbers on the screen don't match the physical reality in the vaults. Let's look at the paper market for a second. For every ounce of physical silver, there are hundreds of paper contracts. It's a digital mountain built on a tiny grain of metal. Most people buying silver never actually see it. They trust a certificate or a digital balance. But what happens when everyone wants their metal at the same time? The math simply doesn't work. Wall Street banks have been caught manipulating these trades before. They call it spoofing. It involves placing massive orders and canceling them instantly to move the price. They've paid billions in fines over the years. To them, those fines are just the cost of doing business. Does a fine really stop the behavior if the profit is higher? Probably not. Honest investors are getting squeezed out by algorithms. These bots can trade millions of ounces in a heartbeat. It happens so fast that a human can't even react. Is this a fair market or a rigged game? Look at the global inventory levels. London and New York vaults are reporting massive outflows. Silver is moving from the west to the east at record speeds, yet the spot price barely moves. It's like gravity stopped working for precious metals. Why would anyone sell physical silver below the cost of mining it? That's exactly what's happening right now. Mining companies are struggling to keep the lights on. The energy required to pull silver from the ground is getting more expensive. But the price of the finished product stays flat. It feels intentional. You might think the regulators would step in. History shows they usually arrive after the damage is done. They track the paperwork, not the actual bars of metal. If the silver isn't in the vault, the paperwork is worthless. How many people can own the same bar of silver? In the current system, the answer might shock you. It's a game of musical chairs, played with billions of dollars. And the music is starting to slow down. We need to follow the trail of the physical metal. Forget the charts and the digital tickers for a moment. The truth is hidden in the shipping containers and the private warehouses. Are you ready to see how deep this goes? It's time to look at the evidence. Let's start with the central banks. They don't talk about silver as much as they talk about gold, but their influence is everywhere in the shadows. Many people believe silver is just an industrial byproduct. They want you to think it's no different than copper or zinc. If you view it as a mere commodity, you won't treat it like money. That's exactly what the banking system wants. They need people to stay inside the digital currency loop. If silver breaks free, the whole illusion of the dollar is at risk. Look at the warehouse receipts from the major exchanges. You'll see categories called registered and eligible. Registered silver is supposed to be available for delivery right now. Lately, those numbers have been hitting multi-year lows. It's getting harder to find large bars for immediate pickup. When a big buyer demands physical delivery, the exchanges scramble. Sometimes they offer a cash settlement instead of the metal. Why would they do that if they had the silver? It's like a bank run, but in slow motion. They're trying to settle debts with paper to save the physical stash. Have you noticed the premiums lately? The price you pay at a local coin shop is much higher than the spot price. That gap is the real price of silver. The spot price is just a number generated by a computer in London. It doesn't represent the cost of a real coin in your pocket. This disconnect is the first major red flag of fraud. The market is splitting into two different worlds. There's the fake paper world and the real physical world. One of them has to break eventually. Think about the massive short positions held by the big banks. They sell silver they don't even own yet. They promise to deliver it in the future at a lower price. By flooding the market with these promises, they drive the price down. It's a self-fulfilling prophecy designed to kill momentum. When the price starts to rise, they dump more paper contracts. It creates a flash crash that scares away retail investors. So you've probably seen it happen on the charts on a Sunday night. Liquidity is low, and suddenly the price drops 50 cents in a minute. That isn't natural selling. That's a coordinated strike to trigger stop-loss orders. It's a way to harvest money from smaller traders, and it happens almost every single month. The evidence is written in the trade logs. The regulators see it, but they often look the other way. Why would they disrupt a system that keeps the currency stable? A high silver price is a signal that the currency is failing. No government wants that signal flashing on every news screen. So they manage the price to manage your perception. But the physical metal is running out. The world's largest mines are reporting lower ore grades. They're digging deeper and finding less. The supply crunch is no longer a theory. It's becoming a reality. Look at the tech industry. Every smartphone contains a small amount of silver. Every electric vehicle needs it for the battery and the sensors. Solar panels are the biggest new players in the market. They consume hundreds of millions of ounces every year. The world is moving toward a green energy future. This future is built entirely on silver. You can't build a solar farm with paper contracts. You need the actual metal. But the manufacturers are getting nervous. They're starting to go directly to the mines to secure supply. They're bypassing the traditional exchanges entirely. Why would they do that if the exchanges were reliable? It's because they know the paper market is a fantasy. They can't risk their production lines on a digital promise. Now, think about the silver that's already been used. Unlike gold, silver is often consumed and thrown away. It's in bandages, mirrors, and tiny circuit boards. Most of it ends up in landfills because it's too expensive to recycle. Gold stays in vaults, but silver disappears into the trash. This creates a massive hole in the global supply. The available stockpile is shrinking every single day, but the price doesn't reflect this scarcity yet. Why is that? It's because of the way the LBMA and COMEX operate. These are the two pillars of the global silver trade. They set the price for the entire world, but they don't actually move much physical metal compared to their trade volume. It's mostly just numbers moving between bank accounts. What happens if a major tech company demands 10 million ounces tomorrow? The system would likely seize up. We've seen hints of this during recent market events. Do you remember when silver coins became nearly impossible to find? The spot price was low, but the shelves were empty. That was a preview of the coming collapse. The dealers couldn't get the metal from the wholesalers. The wholesalers couldn't get it from the refineries. The whole chain was broken. Yet, the paper price on the screen kept dropping. It was a total decoupling of reality. This is the fraud in its purest form. It's a price discovery mechanism that ignores supply and demand. It's designed to benefit the people who trade the paper. It isn't designed to protect the people who own the metal. Look at the history of the Hunt brothers. They tried to buy up the physical supply in the 70s. The exchanges literally changed the rules in the middle of the game to stop them. They didn't want anyone to own the real thing. They still don't. The rules are still stacked against the individual. But today it isn't just two brothers. It's millions of people around the world starting to catch on. Consider the role of leasing in the silver market. Banks often lease silver to industrial users or other institutions. This allows the same bar of silver to be counted on multiple balance sheets. It's like renting out your house to 5 different families at once. Everyone thinks they have a place to stay until they all show up at the door. In the silver world, this is called rehypothecation. It's a fancy word for selling the same thing multiple times. This creates a massive phantom supply. On paper, it looks like there's plenty of silver to go around. In reality, the vault might be nearly empty. The banks rely on the fact that most people won't ask for delivery. They bet on your complacency. They want you to be happy with a digital statement. But what if a major sovereign nation decides to audit its holdings? We've seen countries like Germany ask for their gold back in the past. It took years for the metal to actually be returned. If the metal was there, why did it take so long? The same questions apply to silver, but on a much larger scale. The industrial demand makes silver even more vulnerable than gold. A factory can't wait 5 years for a shipment. If they don't get the silver, the assembly line stops. This is the ticking time bomb in the financial system. Have you checked the open interest on the commodity reports? It shows the total number of outstanding contracts. Frequently, the open interest represents more silver than exists in the vaults. The exchange just assumes most contracts will be settled in cash. It's a high-stakes game of chicken. The shorts are betting the price will fall so they can buy back cheap. The longs are betting the price will rise so they can profit. But neither side is usually looking for the metal. Until now. A new wave of investors is focusing solely on physical possession. They're taking the metal off the market and putting it in private safes. Every ounce removed from the system makes the fraud harder to maintain. The float of available silver is getting dangerously thin. You can see the desperation in the way the banks trade. They're using more aggressive tactics to keep the price down. They're printing more paper silver than ever before. But they can't print physical atoms. They can't manufacture silver out of thin air like they do with dollars. This is the fundamental flaw in their plan. The laws of physics will eventually override the laws of high finance. Look at the premiums on silver bullion in different countries. In places like China or India, the price is often much higher than in New York. The arbitrage should close that gap. But it isn't closing because there isn't enough metal to move. The physical market is screaming that the paper price is wrong. Are you listening to the warning? The evidence is hiding in plain sight. It's in the delivery delays and the shrinking vault totals. The curtain is starting to pull back. Let's talk about the silver squeeze phenomenon. A few years ago, thousands of people tried to break the system. They bought up every silver coin they could find. The websites of major mints actually crashed. Retail dealers completely ran out of stock for weeks. You'd expect the price to double or triple under that pressure. Instead, the paper price barely moved. In fact, it actually dropped shortly after the peak of the buying frenzy. How is that possible in a free market? It's only possible if the market isn't free. The big players used their leverage to flood the futures market with sell orders. They created an artificial wall of supply to crush the sentiment. It was a message to the small investor. The message was, we control the price, not you. But that victory for the banks was only temporary. They had to use up a huge amount of their physical cover to pull it off. Every time they suppress the price, they make silver more attractive to big buyers. Smart money loves a bargain, especially when it's manipulated. Look at the movement of silver into private vaults in Singapore. Millions of ounces are being quietly moved out of the Western banking system. These buyers don't care about the daily fluctuations on the COMEX. They're looking at the long-term structural deficit. The world produces about 800 million ounces of silver a year. But the total demand is now consistently over 1 billion ounces. That gap has to be filled by someone's existing stockpile. Those stockpiles are not infinite. In fact, they're reaching a breaking point. Think about the silver mining industry for a moment. Most silver is found as a byproduct of mining for lead or zinc. There are very few primary silver mines left in the world. This means you can't just turn up silver production because the price goes up. Even if the price hit $100, new supply would take years to arrive. You can't just flip a switch and get more metal. The scarcity is hard-coded into the earth. But the fraud keeps the price so low that new mines aren't being built. It's a cycle of suppression that guarantees a future shortage. The banks are essentially cannibalizing the future of the industry. They're keeping the price low to protect their current short positions. But by doing so, they are ensuring a massive supply shock later. Have you ever looked at the debt-to-silver ratio? If you price silver based on the amount of money printed, the number is staggering. Some analysts suggest the real value should be in the hundreds, yet it sits in the 20s. That gap represents the magnitude of the manipulation. It's a coiled spring held down by a very heavy thumb. What happens when the thumb gets tired? Or what happens when the spring just snaps? The evidence of the tension is everywhere. You just have to know where to look. The next phase of this story involves the actual bars in the vaults, and that's where things get really strange. Let's look at the actual silver bars held in major vaults. Standard commercial bars weigh about 1,000 ounces each. They're the size of a large loaf of bread and very heavy. In theory, every bar has a unique serial number and a hallmark. This allows for a clear chain of custody from the refinery to the vault. But several audits have raised uncomfortable questions. There are reports of bars with the same serial numbers appearing in different locations. How can the same physical object be in 2 places at once? It can't, unless the record keeping is intentionally flawed. Some experts believe that many vaults are holding placeholder bars. These might be lead bars plated in a thin layer of silver. It sounds like a conspiracy theory until you realize it's happened with gold. In 2020, a massive gold counterfeiting scandal rocked the Chinese market. Thousands of gold bars turned out to be copper inside. If it can happen with gold, why wouldn't it happen with silver? Silver is much easier to fake because its density is closer to common metals. Most investors never actually test their silver with ultrasound or x-rays. They trust the paper certificate that says the metal is there. But a certificate is only as good as the institution that signs it. If the bank goes bust, that paper doesn't turn into metal. You become an unsecured creditor in a long line of people looking for money. Is your wealth really safe if it's just a line of code in a bank S-ledger? The fraud extends to the exchange-traded funds, or ETFs. Many people buy silver ETFs thinking they own the metal. If you read the prospectus carefully, you'll see some troubling language. Often, the fund is allowed to lease its silver to other parties. This brings us back to the problem of having multiple owners for one bar. In a crisis, the ETF might not be able to give you physical silver. They reserve the right to settle your shares in cash. If the price of silver is skyrocketing, getting cash is the last thing you want. You want the asset that is actually rising in value. The system is designed to keep you away from the exit door. Look at the timing of the major price drops over the last 10 years. They almost always happen when the physical market is closed. They happen in the middle of the night when there is no physical demand. It's the perfect time for a bank to dump thousands of paper contracts. This forces the price down without the bank actually losing any metal. It's a psychological game played with your retirement savings. They want to make silver look like a bad investment. If they make it volatile and frustrating, you'll sell and go back to stocks. They need you to stay in the traditional financial system. Because as long as you're in their system, they control the rules. Silver is one of the few ways to step outside of that control. That's why they work so hard to keep a lid on it. But the lid is starting to rattle. The pressure from the industrial side is becoming too great to ignore. The fraud is being squeezed by the reality of the physical world. What happens when the biggest tech companies can't get the metal they need? That's when the real show begins. Imagine you are a CEO of a major solar panel manufacturer. You have contracts to deliver millions of units next year. If you don't have silver, your factory stands still. You won't look at the COMEX price and wait for a dip. You will pay whatever it takes to get the metal delivered to your door. This is the industrial panic that the paper shorts fear most. When the buyers stop caring about the screen price, the manipulation ends. We are seeing the early stages of this panic right now. Inventory levels at the Shanghai Future Exchange are plummeting. The East is physically hoarding silver while the West trades paper. They are essentially draining the pool while the lifeguards are looking away. Look at the premiums on silver in India during the wedding season. The demand is so high that the local price stays far above the global average. This creates a massive vacuum that pulls silver out of Western vaults. Eventually, the vaults in London and New York will be empty. What happens when the COMEX declares force majeure? That's a legal term that means they can't fulfill their contracts. It's the ultimate get-out-of-jail-free card for the big banks. They just give everyone their dollars back and keep the remaining metal. If you held paper silver, you'd be left with cash that is losing value. If you held physical silver, you'd be one of the few with the real asset. The fraud is designed to make sure you are on the losing side of that trade. Think about the recent changes in Basel III regulations. These rules were designed to make banks hold more stable assets. Gold was reclassified as a Tier 1 asset, making it as good as cash. But silver was left out in the cold. Why keep silver in a lower category if it has been used as money for 5,000 years? It's another way to discourage banks from holding it and promoting it. The system wants silver to be seen as the industrial waste product. But the numbers tell a different story. The ratio between the price of gold and silver is historically wide. For most of history, it took about 15 ounces of silver to buy 1 ounce of gold. Today, that ratio has climbed as high as 80 or 90 to 1. This gap is not based on geology. There's only about 8 times more silver in the Earth's crust than gold. The price ratio is an artificial creation of the paper market. It is a visual representation of how suppressed silver really is. If silver returned to its historical ratio, the price would have to explode. The banks know this math better than anyone. They are trapped in a massive short position they can never fully close. Their only strategy is to keep doubling down on the lie. They print more paper to cover the old paper. It's a giant Ponzi scheme with a metallic face. Every day they keep the price low, they dig the hole deeper. Have you ever seen a spring compressed to its absolute limit? The energy stored inside is immense. The longer the fraud lasts, the more violent the eventual breakout will be. You can feel the vibration in the market data. The cracks are appearing in the foundation of the clearinghouses. Let's look at who is actually sounding the alarm. It's not just gold bugs anymore. It's the people who actually handle the physical metal every day. Listen to the people running the mints. They're reporting record wait times for blank coins. The refineries are working at full capacity but can't keep up. If there was plenty of silver, there would be no bottleneck. The bottleneck exists because the metal is being diverted. Sovereign wealth funds are likely buying directly from the source. They see the instability in the global debt market. They know that silver is a hedge against a failing currency. Think about what happens to silver during a period of high inflation. When the value of paper money drops, hard assets stay the same. It takes the same amount of silver to buy a loaf of bread today as it did a century ago, but it takes many more dollars to do the same thing. The fraud hides this reality by making silver look like a volatile gamble. Honestly, the real gamble is holding your wealth in a digital account. You're trusting a system that has already been fined for cheating. It's like playing poker with a dealer who has been caught hiding cards. Why would you expect the next hand to be fair? Look at the rise of private vaults outside the banking system. People are paying for high security storage that is totally independent. They want to know their silver is there when they look at it. They don't want a pool allocated account or a digital credit. They want the specific bars with their specific serial numbers. This movement is growing every single day. It's a quiet exodus from the traditional financial world. The banks see this trend and they are terrified of it. If everyone withdrew their physical metal, the fraud would end in 24 hours. The system only works because we assume it works. Once that trust is gone, the paper contracts become just paper. Look at the silver to oil ratio or the silver to housing ratio. By almost every historical metric, silver is the most undervalued asset on Earth. This isn't an accident. It's the result of decades of careful price management. But the world is changing. Digital transparency is making it harder to hide the truth. Online communities are tracking the vault outflows in real time. The secret isn't a secret anymore. You can see the evidence in the delivery notices and the warehouse reports. The math is moving against the manipulators. The industrial demand is the final hammer that will break the glass. When the solar and EV companies can't find metal at the spot price, the game is over. They will pay the real price and the paper market will collapse. Are you prepared for that moment? Do you have the metal in your own possession? Or are you holding a promise from a bank? The evidence of the fraud is shocking, but the consequences are even bigger. History shows that truth eventually finds its way to the surface. With silver, that truth is heavy, solid, and impossible to ignore. Look at the data one more time. The countdown has already started. Don't wait for the news to tell you what happened. The signs are already here.